Hey guys, Sean Pruitt here. Let's talk about oil and gas and where we are heading for 2023. Now, I want to focus more on the supply and demand. Okay. And so I got a lot of data for you. I've looked at a lot of information. Right now, oil prices, WTI crude's trading at 79.77. Brent crude is at $85 a barrel. So it's a strong opening for this year. And oil prices gain on optimistic U.S. inflation data, okay? Slowing U.S. inflation provides impetus for oil. Lower gasoline prices contributed to a lower CPI figure, okay? Cost per an index. Now, here's the thing. Gas prices affect everything, okay? 5% of everything you buy on Amazon comes from the price of crude, okay? And another 40 or 50% is travel, okay? For airlines, for taxi cabs, and so on and so forth. So most of your expenses are affected by the price of crude. Now, let's say that you own, the Federal Reserve, okay? The Federal Reserve note is the most powerful institution in the world. We could print money and amass the largest military in the world, and we could police the entire world. That's what we've done. Imagine if Putin had our power. He would dominate the whole world. Imagine if Xi Jinping had the ability to print as much money as he wanted, and if he had the ability to settle all his oil and gas purchases. In every single global superpower is buying and selling using the yuan, using his currency. He would amass the largest military in the world. He would have already taken over Taiwan. And you know where I'm going with this. And so America is the only country that has the ability to print as much money as they want. Now, if inflation gets out of control, it destroys the power of that dollar, okay? So they're going to do whatever they can to get inflation under control, okay? And so they've increased the interest rate hikes, reducing the amount of capital, okay? And so now we have less capital, and it prevents the ability to invest more in oil. And you couldn't chase the commodity price rally. And so oil prices, fundamentally speaking, should be much higher, but there's nobody to buy the financials, to invest in the stock market and chase that rally, okay? Now, with that said, inflation, they're trying to protect the most powerful entity that keeps our country flowing, that keeps us as a superpower. And it's, if they didn't have the ability to print money anymore, we can't manufacture tanks. We can't manufacture fighter jets. We can't pay in a massive military force to be the police of the world. And countries like Iran stay at bay. Countries like Russia stay at bay because we have the ability to send billions and billions of dollars, for instance, to Ukraine. Okay. Now, inflation would destroy that power. So they're going to do whatever they can to stop inflation. Okay. Now, the largest contributor to inflation is the price of crude. Okay. So, for instance, the Energy Information Administration is funded by these dollars, funded by the USD, funded by the Federal Reserve. Okay. So they're very biased when it comes to the data that they put out. There's a tremendous amount of data that is wrong on the EIA. Their expectations of Shell is completely wrong. Okay. It's been wrong since the inception of Shell. And I was saying on my small, little, insignificant YouTube channel, I was saying, hey, listen, Shell is a flash in the pan. Oil is, and everyone believed that we were going to be an oil glut forever. We were going to be a net exporter of oil. We were going to never need Saudi Arabia ever again. And then look where we are today. Very respectable oilmen that I've watched for years, that I've studied for years, were saying we will never see $100 oil ever again when we were swimming in Shell or oil. Everybody, except for a few, were wrong. Okay, so fast forward today, Shell is on the decline. We're not spending near as much money on capex spending. We'll never spend the kind of capital we did back in the days of 2012. So I'm going to read a few articles here. So Saudi Aramco chief sounds Alarm over global oil supply capacity. Now, Saudi Aramco chief, the head guy, Aramco is the largest company in the world. It is bigger than Apple. They're financially healthier than Apple is, and it's an oil company. Okay, so I find it interesting that people think we don't need oil, but they make more money than Apple does. Okay, and if the head guy for Apple comes out and has a statement to say about manufacturing Apple products, whether it's in the microchips or whatever, everybody's going to listen. Okay, if they said, "Hey, listen, there's a shortage of the microchip that goes into the iPhone and the iPad," that the price of that microchip would skyrocket. Okay, now here is the head honchos for Aramco warning the world. Okay, but nobody believes what he's saying. It's just crazy. So listen, global oil markets remain incredibly tight. The chief executive of the world's biggest crude producer has warned, as he has said, the world was too focused on the demand impact of a possible recession rather than the limitations of current supply. Okay, Riyadh fears that Russian output could fall sharply later this year when Western sanctions against the country's oil exports tighten. And it is keen to keep some spare production capacity in reserve, according to the people familiar with Saudi Arabia's thinking. Speaking at the Energy Intelligence Forum in London, Nasser said current oil prices, which have fallen to less than $90 a barrel from a high of $139 earlier this year, reflected a market focused on short-term economics rather than supply fundamentals. Okay, agree with 100%. Underinvestment meant that global spare capacity, defined as extra crude supply that could be brought online quickly in the event of unforeseen incidents, remained extremely low and would be completely eroded if China relaxes long-running COVID-19 restrictions and begin to consume more, Nasser warned, which China is reducing their COVID restrictions. If China opens up, the economy starts improving, or the aviation industry starts asking for more jet fuel, you will erode this spare capacity, he said. And when you erode that spare capacity, the world should be worried. There will be no space for any hiccup, any interruption, any unforeseen events anywhere around the world. Okay. Nasser stressed that this decision had been taken in 2020 and that it would be extremely difficult for the rest of the industry to suddenly ramp up long-term supply, implying that the world was in for a prolonged period of high oil prices. Even if we decide we are going to increase investment, it is going to be difficult. It will take a number of years. So he's saying, even if we decide we are going to increase investment, see, they haven't even decided to increase investment. Why would you? I mean, the shell industry finally is bringing in a tremendous amount of profits. And religiously, they are reducing the amount that they spend on development, because why would they? If they increase the amount of development and increase the world oil supply, and everybody has the same attitude, if they increase the world oil supply, it's only going to reduce the value of their oil. So if they could just be just as profitable where they sit without spending even more money in development, why wouldn't they? And in addition to that, if you are truly concerned that there's not enough oil in the ground, why would you take up all your spare capacity just to reduce the value of your oil just to make the same amount of money? That doesn't make any sense, okay? And so here's the thing. He's sounding the alarm bells, but nobody believes what he's saying. Look here, here's a article. Morgan Stanley expects the oil market to tighten during the third and fourth quarter of 2023. China's reopening, recovering aviation risk to Russian supply slowdown in U.S. shale, and the end of the SPR releases turning into tailwinds. Okay. And so you've got everybody sending the alarm bells regarding the same thing. Okay. But again, nobody really believes what is happening. And so, and because if you look at oil prices hit as high as $130 something a barrel last year, and then they dropped. Okay. Now they dropped not because of fundamentals. They dropped because of the financials. Okay, because they're playing games in the background. The most powerful institutions in the world, Federal Reserve, the USD, the stock market are and using the media to parakeet information to drive oil prices down. They pushed the whole recession fears. And so there's three major reasons. We had recession fears. The impact of the EU embargo, everyone was expecting Russian oil production to decline, but it didn't, okay? And then you have the China. We had massive China lockdowns, okay? But the thing is that if you look at Eric Nuttall had this post the other day. Global oil inventories ended 2022 at 150 million barrel deficit. Okay. So last year, we had our strategic petroleum reserve flooding the markets on average 800,000 barrels of oil a day. We had the China lockdowns. Russian oil did not decline, but we still have a deficit of 155 million barrels of oil last year. And a lot of that strategic reserve that we released from our strategic reserve went into other people's reserves. Okay. So the 155 million barrel deficit would be much higher if we were not releasing from our strategic reserve. And so here's the thing. If we had enough oil, we would not be taking 155 million barrels of oil from our strategic reserves. You tap into your savings when you are desperate. But in my household, if I have to tap into my savings, that means some bad things are happening. In the event that I need some extra capital, I might sell some stock. I might sell some oil leases or some oil reserves or whatever. I've got many things, or take some cash out of the bank. But if I exhaust 100% of the money that I have in my checking, if I exhaust all the excess capital that I could get from selling anything, whether it's real estate or oil or royalties or production or whatever, if I exhaust all of that, I'm in a serious, desperate position, and now I have to tap into my savings. America tapped into its savings account because they are desperate. Desperation. And if we're having to tap into our savings when oil demand wasn't as high as it should have been because of COVID lockdowns and everything in recession fears. I mean, the entire markets were in disarray last year because of recession fears. Everybody thought we were going to see a massive reduction in demand. Everyone thought we were going to see horrible times ahead because of these recession fears, and everyone thought these market rate hikes were going to erode and destroy demand. Well, we still tapped into 155 million barrels of oil last year. Okay. And if you look at, this is a spreadsheet that was put together by OPEC. Okay. OPEC, it stands for Saudi Arabia and many other countries, and they know more about oil than the EIA. Okay. The Energy Information Administration is a joke. Okay. They know more about supply versus demand, and they know more and they keep track of this, and they're unbiased. Okay. And when I say unbiased, I'm referring to the political scape of trying to protect the U.S. dollar. They're not trying to protect the U.S. dollar. They're trying to make the world understand, look, this is all the data, and we've put it together. And they've been very accurate over the years, more accurate than most people. Okay. So if we look at, let's look here. Okay. So this is the average demand for 2021, 97.01. Okay. And this is, if you look at the, so this is world oil demand. Okay. Now, if you look at 2022, first quarter of 2022, we had a demand of 99.35 million. We had a demand of 98.21 million for second quarter. For third quarter, we averaged about 99.54 million. And the fourth quarter, we ended with about a demand of about 101.11 million barrel a day demand. Okay. So let's look at what they're expecting for 2023. The first quarter, they're expecting 100.87 million barrel a day demand. Second quarter, they're looking at 100.74. But quarter number 3, you see a significant increase, 102.09 0.04. And the last quarter, we're expecting about 103 million barrel a day demand. Now, last year, we averaged about 99.56 million barrel a day demand. Next year, we're averaging for 2023 about 101.7. Okay. So if we only had a demand of 99.56 million last year, and we depleted our reserves by 155 million, which is an average of about 500,000 barrel a day deficit. Okay. Then what do you think is going to happen when you have the U.S. shale nearing peak? And listen, we are not going to spend the capital with the ESGs and all the stipulations in place and all the negative sentiment against oil. I mean, global warming, all those things. Nobody's ever going to spend the capital that they did in the days of 2012 through 2019 in shale. And the shale growth is over. In addition to that, most of the easy to get to oil, the low hanging fruit, has already been developed. So if we match the enormous amount of capital in the shale industry like we did in the days of 2012 through 2016, 2017, there still would not be enough oil because we're having to spend more money to get a barrel of oil because all the easy to get to sweet spots are completely eroded. So you got the shale degrading, and you have the demand increase. You got the China open up, and you've got we're going to potentially lose about 1 million barrels a day from Russia because the EU embargoes are kicking in, and the oil price cap on Russian oil is kicking in, and then you got the China demand that could be upwards of see what was the numbers? I wrote it down. They're expecting China increase to 800,000. China reopening is looking at an incremental increase of 1.5 million. So it might be 100,000 today and grow up to 1.5 million barrel a day demand. And then they're looking at the EU embargo causing a reduction of about 800 to 1.3 million barrels a day. So between China and Russia, we're looking at a deficit of 3 million barrels a day. And last year, we lost about 500,000 barrel. We had to tap into our strategic petroleum reserve about 500,000 barrels a day, and we still are on the decline with shale. So listen, there's just not, and forgive me for being all over the place about this. It's hard to track all the data. I mean, you just can't. I mean, you got guys like Jeff Curry, that is the oil and gas analyst for Goldman Sachs, and that's all he does all day long. Okay. He spends his whole life doing it, and he spends his whole life talking to people that just focus in the oil and gas industry. And it's a very difficult thing to follow. Okay. And then he does all the work, and then nobody believes what he has to say. Okay. Because they believe the financials. They believe what they're seeing on the financials versus the truth of the fundamentals. Okay. I'm going to read another article here. And so this is a great article exploring hydrocarbon. Can global oil production climb if the U.S. shale boom is over? U.S. production growth was responsible for 98% of the increase in world production in 2008. Okay. So 2% of the world was accounted for the growth. Okay. And then the other 98% was U.S. shale. Okay. And that's because we're the only country that could fire up the printing presses and spend and drill, baby, drill. We tapped into a formation that is not economically feasible. It's not economical. But the only reason why we can do that is because we have the ability to print like no other. Okay. As where the rest of the world, they have 50 billion, 20 billion, 5 billion to spend on oil development, as where we could blow 300 billion in a month. Okay. We're the only country that can do that. And so this shale revolution was artificial. It was artificial, and it was 100% stimulated by the power of the printing press. And we're the only ones that can do that. Okay. And so we printed money. We built our shale. We spent it on shale development, but it's a flash in the pan. It's a fast declining reserve. And if Russia was to do what we did, they'd be bankrupt. If Saudi Arabia was to do what we did, they'd be bankrupt. We're not bankrupt because everybody uses our dollar. It's highly demanded, and we could print as much money as we want. Now, here's the deal. There isn't as much accessible and economical shale oil underground as advertised. Earth scientist David Hughes laid out his case for The View in his Shale Reality Check 2021. There may be other sources of worldwide that will somehow make up for significantly lower growth in U.S. shale oil production, but no other source seems to provide the kind of growth U.S. shale oil provided. That is 73.2% of the global increase in oil production from 2008 through 2018. Neither the U.S. shale oil companies nor OPEC seem ready to increase production significantly, assuming that they can. Russia, among the world's top 3 producers, is under heavy sanction and may not be able to produce more oil for export anytime soon. Again, it is not certain that Russia could significantly increase production, except for the pandemic-induced drop. Russia has long been on a production plateau of between 10 to 11 million barrels a day. No doubt some new oil savior will be announced soon, whether credible or not. In the meantime, the world economy will be faced with limited oil supplies that do not simply grow to meet our fantasies of what we want. The result will be high prices, that is higher than has been historically the case. A recession won't change this dynamic, and in fact may reinforce, as oil companies are likely to reduce drilling activity when demand for oil slumps. That will make it doubly difficult for those companies to supply growing demand coming out of the next recession. This is the way things might very well be for a long time, if not indefinitely. Many of us who foresaw this day said that we would only see peak world oil production in the rearview mirror. It may take a few more years to determine if November 2018 marked the all-time peak. Okay, so you've got a lot of false hopes in U.S. shale. The Energy Information Administration keeps sending false hope to the world, and they believe it. And the fundamentals of when it comes to analysts, market analysts, that seem to be getting it wrong, they're really getting it right. But the Federal Reserve, the stock market, the financials are in the driver's seat. But how long can we keep oil prices low that's manipulated by artificial things, by financial markets and by financial systems versus the supply? Okay, we're in treacherous waters right now. Okay, and we keep kicking the can down the road. Last year, oil prices stayed low simply because of fear and speculation, and had absolutely nothing to do with fundamentals. At what point does the fundamental start driving the oil price? That's when it's going to take something serious. It's going to take that demand of 100 million hitting 103 that OPEC is expecting by the end of the year, and see a massive reduction in the strategic reserves, and see that there's just not enough oil. And then when there's not enough oil, the byproduct of oil is gasoline. And so when gasoline prices really go up, okay, because if you look at what Eric Nuttall said, we have a deficit of 350 million barrels last year of refined products, okay, the various fluids, and gas is one of them, okay? We had a massive deficit. They're going to have to convert that crude oil to fulfill that deficit of gases, because all the byproducts of oil, okay? Where's that going to come from? They have to get that raw crude, okay? And so when you see gas prices going up, that's when the concern, but they saw gas prices drop. So it's like, oh, guys, we have plenty of oil. And that's just simply not the truth, okay? If you look here, this is capex spending from 2010 to 2020. Okay, I don't have, again, data is hard to come by. Okay, they don't have, I'm missing 2021, 2022, 2023. But if you saw the chart, it would be much lower. Okay, so if you look here, the light blue is what I want to focus on. Okay, the dark blue is the power sector. The light blue is oil and gas. Okay, now this is the money that we spent on oil and gas. 24, we peaked. Okay, at 1.1 trillion. Okay, dollars. Okay, we spent 1.1 trillion dollars globally to spend to find oil and natural gas, the development of oil and natural gas. And then in 2015, we dropped from 1.1 trillion to $891 billion globally. Okay, 2016, we dropped to $734 billion. 2017, we used $757 billion. 2018, about the same, $767 billion. 2019, $756 billion. And then a major drop to $500 billion globally. So from 2014 to 2020, we've dropped more than half of the capex for global oil development. Okay, 2021, 2022, 2023, we've seen even a higher significant drop, okay, in global oil development. Now, with that said, if we were spending in 2014, and this is global oil supply by country, okay, or production. Okay, so 2014, okay, if you look here, 2014, we spent over $1 trillion on global oil development, okay? And as you can see here, we skyrocketed in production, okay? Now, if you look here, that skyrocket is predominantly U.S. shale. U.S. shale, Saudi Arabia is mainly conventional oil, which their decline rate is about, on average, globally, the world oil decline is 10%. So if I drill a well, it's going to naturally decline, okay? Because the underground pressures are going to drop naturally and everything declines. So globally, on average, oil production declines by 10%. U.S. shale declines 45%. So 4.5 times faster than the average Saudi oil well, for instance, okay? So if we spent over $1 trillion and we grew, and we hit this high right here, now the spending has dropped in half, okay? And shale is on the decline of 45%. So for every million barrels of oil, we need to find another 450,000. But they're not spending enough to keep up with that 450,000. In fact, they're not spending enough to even, and so that's why we're seeing a decline, okay? We're never going to see that kind of capital ever again, because the capital discipline that you're seeing from U.S. oil companies, the capital discipline you're seeing from Saudi Arabia, the capital discipline from Russia, the world is not spending enough money on the development of oil and gas, because the more money they spend on the development of oil and gas, they're seeing an increase in supply, and then they're seeing a lower in oil price. So they make more money not developing. OPEC is not spending the capital they need. The U.S., you'll never see the printing presses fire up for the oil and gas industry. Number one, most Americans are sitting on their hands when it comes, well, what do I invest in? I mean, everyone's saying that I need to invest in green and all the incentives that come with green, the tax benefits and everything else. And they have the marketing of CNN and all these major news agencies that are just talking about green. Same thing they did with Shell. They promoted Shell like crazy. 2012, the Shell boom, 2013. Everybody wanted to invest in oil and gas. Now you got the ESGs, you got the administration in place telling you how evil oil and gas is and how it's destroying the world. And then you have the basic risk of oil and gas prices eroding the power of the U.S. dollar, the power of the U.S. economy. And so, and they've got trillions and trillions of dollars to protect for the stock markets. So they're going to do whatever they can to reduce the price of oil. And they don't have the strategic petroleum reserve to go after anymore. They don't have any other tricks up their sleeve to reduce oil price. Okay, so 2023, man, it's going to be very interesting. Okay, our demand is increasing for oil. India's demand for oil is increasing. The demand in China is increasing. We're gonna see a reduction in Russian oil output. They have upped the ante. America has upped the ante in Ukraine to defend that country. Putin has no choice but to increase the rhetoric and increase his war strategy in Ukraine, because if he pulls out and he loses, he's going to lose his power. And so you've got two power struggles going on there, and neither one of them are going to back down. You got Iran that's increasing and enriching in uranium and increasing their nuclear program like they've never seen before. You got Netanyahu that's increasing his rhetoric, and it's the most hawkish government when it comes to fighting a war against Iran. Okay, you got Saudi Arabia that their war in Yemen is increasing. And so you've got many things in the balance as far as geopolitically speaking that could be very detrimental for higher oil prices. We are on the road for unforeseen situations that could cause oil prices to go up substantially. The Biden administration has no place to hide at this point. We can't tap into those strategic petroleum reserves. Shale oil is over, guys. Look, what you're hearing from the EIA, what you're hearing from the left, what you're hearing about shale, it's all bullshit. It's not here to save us. We don't have offshore production to save us anymore. We don't have shale oil to save us anymore. And OPEC is not going to save us. They're not going to spend billions and billions of dollars that they could be investing in green energy, that they could be investing in expanding their economy, in building more roads, building more infrastructure. Why would they put that in fossil fuels when they know all they're going to do is reduce the price of fossil fuels? And they're tired of the argument falling on deaf ears. Their attitude is like, okay, guys, we are heading to treacherous waters. You guys are heading, and you guys are going to face plant, and we're going to let you do it. And all that's going to do is increase the value of what we're offering here. Okay. And they know the truth about shale. They know that you cannot rely on shale. We've been developing our oil fields in the U.S., and we went from almost 8 million barrels of oil a day and dropped down to 5 million barrels a day in 2008. Then all of a sudden we went to 13 million because of U.S. shale. We went from conventional 5 million barrels a day to unconventional 13 million barrels a day. And now we're seeing a massive decline from 2019 until now. And it's 45% a year. And they're saying that, hey guys, we're going to increase output. The EIA is saying we're going to increase output by 1.5 million barrels a day. That's what they're saying. U.S. shale, 1.5 million barrel a day increase when they don't have the capex. They are reduced to ashes when it comes to funding. They have a marketing nightmare. It's uphill battle. They're never going to win. Okay. In addition to that, all the sweet spots are gone. Dude, guys, it's game over for U.S. shale. That's our only saving grace to make up for the increased demand. Okay. And OPEC is not going to save us. In fact, OPEC is going to drive oil prices up. If there is an increase in production, they're going to decrease their production so they can keep oil prices higher. So there's nothing in sight other than a complete economic meltdown, the crashing of America, the crashing of every single economy. And in times past, you did see a reduction in oil price, but it always climbed back with vengeance. So there's absolutely nothing we can do about it. They've spent $5 trillion trying to reduce the demand for fossil fuels and increase the amount of green energy, and it didn't do anything. In fact, oil prices increased during that time. So we can't, in the past, in our pride, we've printed our way. We've printed and amassed the most powerful military in the world, giving us world dominance. We've printed ourselves into a situation where we had cheap, abundant energy because we're buying all that oil from Saudi Arabia. But for the first time, we can't print our way out of this problem that we've put ourselves into. Okay. So, all right, guys, I'm Sean Pruitt, president of Kingdom Exploration. If you're interested in investing in oil and gas, please go to my description below. Click on the link, fill out the form. I'd love to talk with you. I'm looking at a lot of different oil deals. If you have a great oil and gas program, send it my way. I'll have my team look at it. And again, if you're interested in investing oil, reach out to me. And if you're interested in learning more about the oil and gas industry, whether prices or whatnot, please subscribe to my channel. Thanks.